Welcome to the FinHacksQuants channel. Are you tired of not being able to understand the difference between technical analysis and artificial intelligence in finance? We would like to talk about the problems we have been facing from different angles to help you gain a deeper understanding of our approach of AI in finance. In finance, technical analysis is an analysis methodology for forecasting the direction of prices through the study of past market data, primarily price and volume. Behavioral economics and quantitative analysis use many of the same tools of technical analysis, which, being an aspect of active management, stands in contradiction to much of modern portfolio theory. The efficacy of both technical and fundamental analysis is disputed by the efficient market hypothesis, which states that stock market prices are essentially unpredictable. Technical analysis employs models and trading rules based on price and volume transformations, such as the relative strength index, moving averages, regressions, intermarket and intra-market price correlations, business cycles, stock market cycles, or, classically, through recognition of chart patterns. Technical analysis stands in contrast to the fundamental analysis approach to security and stock analysis. In the fundamental equation M equals P, technical analysis is the examination of M, multiple. Multiple encompasses the psychology generally abounding, i.e. the extent of willingness to buy, sell. Also in M is the ability to pay, as, for instance, a spent-out bull can't make the market go higher and a well-heeled bear won't. Technical analysis analyzes price, volume, psychology, money flow and other market information, whereas fundamental analysis looks at the facts of the company, market, currency or commodity. Most large brokerage, trading group, or financial institutions will typically have both a technical analysis and fundamental analysis team. While some isolated studies have indicated that technical trading rules might lead to consistent returns in the period prior to 1987, most academic work has focused on the nature of the anomalous position of the foreign exchange market. It is speculated that this anomaly is due to central bank intervention, which obviously technical analysis is not designed to predict. Recent research suggests that combining various trading signals into a combined signal approach may be able to increase profitability and reduce dependence on any single rule. History tends to repeat itself. Technical analysts believe that investors collectively repeat the behavior of the investors that preceded them. To a technician, the emotions in the market may be irrational, but they exist. Because investor behavior repeats itself so often, technicians believe that recognizable and predictable price patterns will develop on a chart. Recognition of these patterns can allow the technician to select trades that have a higher probability of success. Technical analysis is not limited to charting, but it always considers price trends. For example, many technicians monitor surveys of investor sentiment. These surveys gauge the attitude of market participants, specifically whether they are bearish or bullish. Technicians use these surveys to help determine whether a trend will continue or if a reversal could develop. They are most likely to anticipate a change when the surveys report extreme investor sentiment. Surveys that show overwhelming bullishness, for example, are evidence that an uptrend may reverse, the premise being that if most investors are bullish they have already bought the market, anticipating higher prices. And because most investors are bullish and invested, one assumes that few buyers remain. This leaves more potential sellers than buyers, despite the bullish sentiment. This suggests that prices will trend down, and is an example of contrarian trading. Research have suggested that there is statistical evidence of association relationships between some of the index composite stocks, whereas there is no evidence for such a relationship between some index composite others. They show that the price behavior of these Hang Seng Index composite stocks is easier to understand than that of the index. Artificial intelligence, neural network. Since the early 1990s, when the first practically usable types emerged, artificial neural networks (ANNs) have rapidly grown in popularity. They are artificial intelligence adaptive software systems that have been inspired by how biological neural networks work. They are used because they can learn to detect complex patterns in data. In mathematical terms, they are universal function approximators, meaning that given the right data and configured correctly, they can capture and model any input-output relationships. This not only removes the need for human interpretation of charts or the series of rules for generating entry-exit signals, but also provides a bridge to fundamental analysis, as the variables used in fundamental analysis can be used as input. As ANDs are essentially nonlinear statistical models, their accuracy and prediction capabilities can be both mathematically and empirically tested. In various studies, neural networks have been failed for generating trading signals given various technical and fundamental inputs have only outperformed buy-hold strategies as well as traditional linear technical analysis methods, when combined with rule-based expert systems. While the advanced mathematical nature of such adaptive systems has kept neural networks for financial analysis mostly within academic research circles, in recent years more user-friendly neural network software has made the technology more accessible to traders. However, large-scale application is problematic because of the problem of matching the correct neural topology to the market being studied. Finally, don't forget to like, share, subscribe and switch on the notification bell so that you won't miss any of our new release content. Have a good one, see you all in the next video.